In this video, we will discuss the concept of volume, the companion to price action. As we discussed, the market is comprised of countless participants who are all driven to buy and sell by the same motivation, to make money. It is the varying degrees of greed and fear based on innumerable analysis techniques that stimulate them to act on those emotions at different points in time. As we discussed in the video on supply and demand, the competitive markets are inelastic. Supply and demand grows and shrinks at different points. What we want to do is identify volume, identify the big players, because as we know, we rely on them to make large profits. In this chapter, in this video, we will discuss volume and how to identify the big players. Let's jump into it. So let's jump into our conversation about volume. So volume can be seen on a price chart by bars. They're vertical bars that are placed underneath the chart. So you can assess the volume from the candles, but these bars assist us because the bars, the way that they are designed is that each bar measures the total amount of shares which changed hands for the period of time it took to develop the candle, right? So if you look at this particular bar here, this is a big move, this big, this is a big giant move down and then a big giant move back up. So the candle here is very big because there was a large amount of aggressive selling happening here and then aggressive buying back up. So even though this candle is almost the same size as this one, there was more volume there's more volume exchanged hands, more trades happen more trading volume happen in this particular candle. So the volume, the reason why we want to know and want to assess the volume is because one, it offers insight into market psychology, right? Allowing us to measure the emotions that are happening during the session, right? There's a lot of trading volume. That means there are a lot of trades going on, a lot of trades exchanging hands, and it'll allow us to assess that there's a lot of trading going on. So this is a very important price point for traders. And then secondly, it will allow us to determine or give us an inclination to know where the big buyers are, right? Because the aggressive selling and the aggressive buying that truly moves the market is done at the institutional level, is done by the institutional investors. So when we get into the study of supply and demand zones, we'll talk more about volume, but we want to talk about volume and its importance in this session. So I'm going to take us back to supply and demand, and I'm going to use buying shoes as an example. So let's take buying shoes. In the traditional way of buying shoes, people will go into a store and pay a fixed price for a pair of shoes. And if everyone valued shoes, everyone pretty much would value shoes at a certain price. So shoes would stay relatively constant. And then during the time when shoe demand grew and supply was limited, websites like StockX became more popular, which allowed the price to rise in real time as demand increased. So you actually had buyers and sellers that could interact directly. And the sellers, depending on demand, the sellers could raise the price up in real time, right? What you'll see here in this chart, these are some of the statistics from the site, 55 million total resale premium, right, for this particular shoe, right? So their resellers are buying shoes and they're reselling them at a higher price, right? So this is reflective of what's happening in the market. Big buyers are buying stock, buying contracts, and they push the price up and then sell it for a heftier price to make profit, to make the difference. So the reason why we want to know volume, I'm going to use the shoe example. Okay. So if we were part of this StockX exchange selling sneakers, if we saw that on one day, 100 pairs of this one Jordan shoe was being sold, and then we saw the next day 300 pairs were purchased, and then the next day 500 pairs were purchased, we would know that and be able to recognize that there's high demand for this particular shoe because of the volume, the amount that is being purchased. So likewise, if we wanted to get in, we can buy and ride that wave up to a higher price. Okay, so in this graph, I'm showing price, the volume of shoes, and this line increasing is also representative of the price increasing. So as demand is going higher, people are still buying as the price is rising. So we could implement a strategy of purchasing shoes, and since the demand is strong, as the price goes higher, we can sell at a higher point. So this is what we want to do in the market, right? We want to buy as we see demand increasing. As we see the larger buyers buying, we want to get in with them, right? We want to get in with them, and then we want to ride up to a certain point, take our profits. But we want to be in the market, going in the direction of the high value. So this is what I mean by volume, right? I hope this helps out. So if we go back to our phases, right? So what will we look for in phase two? So what will we look for in phase two? Okay. So what will we look for in phase two? In phase two, we will look for big buying volume. So these are big candles here. Say big candles. Okay. Big candles, big candles, big candles, big candles, right? So this is big buying pressure. And if you notice the sell pressure going down, these candles are not as big. Okay. So those moves are not as big. So this is something that we want to be aware of and we're looking for in phase two. And we don't want to hesitate. See, we always think as the price is rising that there's a possibility that price will turn around and sell and take us out. But we have to remember that the big buyers have it in their best interest to continue to push the price up, because as they continue to push the price up, when they finally decide to sell, they'll have a large position and they'll make major profits. So it is in their best interest to continue to push the price up so that they can take bigger profits later on. Now, what about the downtrend? What do we look for during the downtrend? So the downtrend is the same. When we see the big, massive, giant moves, huge, giant moves to the downside, we don't want to be trying to time the buy, time the reversal. We want to continue to trade with the big volume. So here, these are three different times that we could have entered into the market. We'll talk about how to do that later on, but we could enter and catch these big moves downward. It's hard to pick the bottom. It's hard to find out when it's the end. Some people bought right here and they got taken out, and then price went in their favor. Okay. So it's in our best interest to continue selling, continue with the momentum. So what do we look for in phase one and phase three? We will discuss these phases in more detail. We will be trying to find certain higher time frame signals in order to trade during the accumulation and distribution. But once price breaks out of them, once price breaks out of the distribution, we can see the breakout, when we have strong momentum that breaks out of this box, right? Strong momentum that breaks out of the area that it couldn't break above before. So once that area is broken, that's a great sign that we are going to go to the upside. If you see here, the same scenario here, price broke above strongly, came back, did a retest, and kept going. If we look at the distribution here, okay, price was in this box, this range, broke strongly, and continued to the downside. So we want to be looking at the consolidation areas, and we want to look for opportunity to get in on those trades once there's a break out of that consolidation or that range. So big, strong break of this area for a continuous movement to the downside to sell. So that's our discussion on volume. We'll talk about it a whole lot more. I'll give it a lot more context in the supply and demand zone videos. So put your comments and questions in the comment section. See you in the next video.